When it comes to business, we're all facing tough calls, right? And while your intuition is a great tool, it's not really a strategy. So today, we're going to move beyond just gut feelings. Let's dive into a really systematic, powerful framework for making those critical operational decisions.
So just imagine for a second, you're at a huge crossroads. Should you launch that new product or maybe discontinue an old one? Should you outsource a key part of your operation? The stakes are always high and you can feel the pressure mounting.
And look, it is so tempting to just rely on your experience, right? To go with your gut. We all do it. But without a structured method, how can you really be sure you're making the most profitable choice? How do you put all your alternatives on a truly level playing field? Well, that's exactly the problem we're going to solve. Okay, so where do we start? Well, the foundation of any great decision is great data. But wait, not just any data. We need a way to filter out all the noise and focus only on what really truly matters for the choice right in front of us. It's actually a lot simpler than it sounds. For any piece of info, any cost, any bit of income, to be relevant, it has to pass two simple tests. First, it has to be about the future. I mean, what's done is done, right? We can't change the past. And second, it must be differential. That's a key word here. It means it only happens because of the decision you make. Let's really zero in on that second rule, because honestly, it is the most important concept we're going to talk about. A differential cost or income is one that pops into existence if you say yes and completely vanishes if you say no. If a cost is going to be there no matter what you decide, well, we call that unaltered. And for this decision, it's just static. It's noise. All right, let's make this real. Imagine you're deciding whether to launch a brand new product completely from scratch. You're going to need raw materials, machinery, people, a sales team, a big ad campaign, the whole shebang. Now, if you don't launch the product, none of those costs ever happen. So you see, in this case, every single one of those costs is differential. But now, let's completely change the context. The product is already out there, the factory is up and running. Your decision now is much smaller. Should we produce just one extra batch? So what changes? Well, the machinery is already paid for. Your core team is already on salary. Those costs are now unaltered. They exist whether you make that extra batch or not. The only differential costs are for the extra raw materials and maybe a little bit of overtime pay. And boom! This table just lays it all out perfectly. Look on the left. For launching the new product, every single cost, all the income, it's all in the launch column. The don't launch column is all zeros. Everything is differential. But now look at the right side for that one extra batch. The cost for labor and machinery, they're already there in the don't produce column. They're unaltered. Only those top few lines actually change. You see? This is the filter in action. So we've filtered our data, we've separated the signal from the noise, and we're left with only what's future and differential. So now what? How do we actually structure this to make a decision? Let's get into the framework. Here it is, a super clear 5-step process. First, you got to define the problem and your options. Simple enough. Then, set your time frame. Steps 3 and 4 are all about quantifying things. First, you measure the resources you'll need. Then, you give them a proper economic value. And finally, step 5, you compare your options and find the winner. Now, that last step, comparing alternatives, this is where things get really, really interesting. There are two main ways to go about it. The traditional way is probably what you're used to. You just pit option A directly against option B. But there's a much more powerful method called own differentials, where you compare each option against the baseline of, well, doing nothing at all. So the traditional method asks a pretty simple question. Which one of these is better, and by how much? You're only looking at the difference between the two. And if you have 3 options, A, B, and C, you end up comparing A to B, then B to C. It can get messy really fast. But the own differentials method, man, it just flips the whole question on its head. It asks, what is the total economic impact of choosing product A versus not doing it at all? And you do that for B, and you do that for C. So instead of just seeing the tiny difference between them, you get to see the total value each option brings to the table, all on its own. So let me ask you this. Here's why that difference matters so much. Let's say your traditional A versus B analysis tells you that product A is better by $90. My question is, so what? Is $90 a big deal? Does that number actually help you make a decision? The answer, of course, is that it totally depends on the context that the traditional method hides from you. A $90 advantage is massive if product A brings in $100 and product B only brings in $10. But what if product A is worth $100,090 and product B is worth $100,000?
That $90 is literally a rounding error. Who cares? The own differentials method gives you those total values so you instantly see how much that difference actually matters.
And that brings us to a super critical part of the process. Step 4, valuing your resources. And it's not as simple as just looking up what you paid for something a few years ago. No, we need to find its true economic value for the decision you're making today.
Now check out this decision tree. It's basically a roadmap for finding a resource's true opportunity cost. First question, do you already have the resource? If not, its value is what it would cost to get it right now, the cost of acquisition. If you do have it, does it have another use? If it does, its value is still the cost of acquisition because using it here means you have to go buy another one for that other purpose. Okay, but what if there's no other use? Can you sell it? If yes, its value is whatever you'd get for it. That's its net realization value. And if you can't even sell it, its value is 0.
So that whole logic path leads to one of these 3 answers. The resource's value is either what it costs to acquire, what you could get by selling it, or, and this is a big one, it's a sunk cost. A sunk cost means that money is gone. It's in the past, and its value for any future decision is 0. You absolutely cannot let past spending cloud a future decision.
So did you notice what's missing from that list? The one thing we didn't mention? The historical accounting cost. You know, what you actually paid for that asset 5 years ago. That's a past fact. It doesn't meet our very first rule for relevance. It's not a future number. Honestly, this is probably the biggest trap people fall into when making decisions.
Okay, we've built this really solid economic framework. But making a truly great decision isn't just about running the numbers. We've got to zoom out and look at the entire picture.
And this might just be the most important takeaway of all. This economic analysis we've just walked through is absolutely necessary. You can't make a smart choice without it, but it is not, by itself, sufficient. It doesn't give you the whole answer.
Why not? Because our decisions have consequences that never, ever show up on a balance sheet. The numbers on a spreadsheet might tell you that outsourcing a department is going to save you 10%. But what's the impact on the 100 employees you might have to let go? What about the community where your company is a major employer? These are the essential, qualitative factors that you have to weigh right alongside the numbers.
You can really boil it down to this. The numbers, the economic analysis, that tells you what is profitable. But this bigger, qualitative analysis, that helps you understand what is right. And a truly great decision always finds the balance between those two.
So, as we wrap this up, I want to leave you with a question to take back with you. The next time you face a really big choice, don't just ask what's profitable. Use this framework to understand the full picture, and then ask yourself, what is the real impact of this decision?